Mackenzie is run by a few trends I think I would highlight. One, Morningstar so far we've helped make quick work.
Today's fund face-off is between AGF European Equity and Mackenzie IV European Equity. So first with AGF European Equity, it's run by the International Advisors arm of AGF, it used to be headed up by John Arnold, but he recently left the firm, and now you have Rory Flynn, who has taken the reins. Now what they're looking for is they're taking an old school value approach to investing, where they want low price to earning stocks that have high dividend yields, and they're generally also trying to buy stocks that are trading very much out of favor with the market and have seen their prices depressed. And historically, at least in the last few years, this has led to concentrated positions very much in the financial space, among other areas.
So Mackenzie IV European Equity, on the other hand, is run by the Ivy team at Mackenzie. This used to be headed up by Jerry Javasky, who sort of surprisingly retired right at the peak of his career in terms of relative performance. And is now headed up by Paul Musson. It's very much a team approach, and they're really searching for high-quality companies with wide economic moats. They're also looking for global businesses with very clean balance sheets. And that has, right now, is translated into a lot of consumer names and healthcare.
And the performance has been really different between the two funds. So with AGF, you had very strong performance leading up to about 2007, largely on the strength of the financials overweight. But then when the global financial crisis hit, the performance was very poor. And they really haven't managed to recover. Now that you have the European sovereign debt issues overhanging the market, and so they really just haven't been able to gain any traction, it appears. So the performance has wallowed in the fourth quartile for some time now.
Yeah, and the Ivy team is sort of the exact opposite of that. The fund had been lagging, during the raging bull market, sort of in the mid-2000s, when the market collapsed in late 07, early 08. The fund was just, completely outshining its competitors. So, most equity funds were down 20, 30, 40%, and Mackenzie Ivy was sort of flat. And so, although on an absolute basis it was rather unspectacular, at that time, on a relative basis, you were laughing. And that's coincidentally when Jerry Javasky retired. And in up markets, as I said, it is not tended to perform quite as well.
And so looking ahead, I think AGF European, you probably will see much of the same from them. I don't see the overweight to financials going away. And so you probably have a situation where if the European sovereign debt issues somehow magically go away and there's returned optimism to the market, that you probably could have quite a big pop from a fund like this. So there is good upside potential. But there are some things that I would caution about, notably with John Arnold gone, and I suspect it's partly because of the poor performance that he's no longer with the firm, although I don't know for sure. There is some uncertainty as to whether the firm will do things exactly the same way or whether there'll be some changes to the process. Also, AGF has implemented some risk controls, so portfolio constraints on sectors, for instance, so it won't be as concentrated. And so this may have the effect a little bit of closing the barn door after the horse has fled. But even so, I do think there's a fair bit of upside potential. But I would caution that it's also a very high fee fund, so there probably are better options for investors.
You'd probably stop short of recommending it as a result?
Yes.
Yeah. The Ivy, on the other hand, so if you think the market is going to pop and you're looking to take advantage of that, the Ivy, European Equity or any really Ivy fund is probably not your best vehicle to capitalize on that. It's not a really high beta fund, but its risk return profile is that of sort of a steady long-term growth. So mid to high single-digit type of return expectations would be reasonable for this fund. You're not looking at expecting any sort of 30-40% type years. It could happen, but it wouldn't be a reasonable expectation. The upside is that when you get those periods of real strong weakness and everything's being sold off wholesale, hopefully in the past this fund has held up better.
So this highlights that these are two very different funds with different approaches and probably will have very different outcomes going forward. So for more information, check out the fund reports that we have on morningstar.ca.
So run by a few trends I think I would highlight. One, Morningstar so far we've helped make quick work.